Guys, we have a great question here from Yannick asking for some tips on managing trades that you take out of a central bank rate decision. Now, what Yannick did earlier today is he jumped into the pound Aussie earlier with the RBA decision immediately when he saw that the RBA only hiked by 25 basis points. But then, with the trade open, as he read through the statement, and after not really seeing anything meaningfully dovish, he decided to get out of that trade for about a 30 pip gain. So, in line with this, Yannick is asking, how we enter trades like these. Do we jump in at the rate announcement itself, or do we wait for the statement before getting in? So, I thought that was a great question from Yannick. I think the short answer for this one, Yannick, is that it depends on the type of surprise and the context of the trade. Personally, if I know that the rate decision itself is important enough and that the surprise is big enough, I usually get in just like you did immediately on that rate announcement decision as quickly as possible, basically. And the reason why I have more conviction to open on a big rate surprise is you know that a big rate surprise will require markets to do some repricing. And if the surprise on that rate side is big enough, it should be worth at least a scalp higher or lower, depending on the size of that surprise, regardless of what the statement says. So a good example, apart from today's RBA decision, was that SNB decision we had. When was it? Last week or the week before? I didn't wait for the statement on that to jump in. After we did our prep and we knew that a 75 basis point hike would trigger a big downside in the Swiss franc, I jumped in immediately when I saw 75 basis points. It was an automatic sell on the Swiss franc on that. Now, the obvious risk with that is that the statement could paint a completely different picture and the market then reverses. But that's a risk that I can deal with because usually a big enough surprise on the rate side allows you enough volatility to bank some pips or at least take a small loss or get out at break even if the statement then does disappoint or move in the opposite direction. Now, so the way that I think about it is that if there's a big enough surprise in rates, there is a higher probability that the statement should reflect that surprise. So for example, if it's a big dovish adjustment, you would assume that there is a higher probability that the statement should reflect that dovish tone. Or if it's a big hawkish surprise, you would expect the statement to at least reflect that hawkish adjustment. That doesn't always work. Sometimes like today, you get that dovish reaction and then the statement is just kind of like a damn cloth, just like, bit of a nothing burger, not really confirming that. And I think that's why we saw that initial rejection of that move. So in honesty, I think you did this perfectly. Jumping in on that 25 surprise, that was the right decision at that time. And then banking immediately after you read the statement and the statement didn't confirm that dovish stance. I think this was a perfect example, textbook example of the way that I would do it myself. Sometimes you won't be lucky enough to get out with a win. And sometimes there will be something so counter the rate adjustment in the statement. So, for example, sometimes you will see a dovish rate adjustment, but then the statement would have something so incredibly hawkish inside that you see a rapid repricing, that big pop higher, and then an immediate slam lower. In those events, in those cases, you're probably going to get stopped out. You're probably going to take a loss, or maybe if you're lucky enough at break even. So you won't always be lucky enough to get out like today with a win. But I think those examples is the exception and not the rule. At least that's how it's been in my experience of it. And something that you can always use as a barometer is that pre-announcement level. If markets push higher and then immediately pushes lower and taking out that pre-announcement level, obviously the opposite if it's a sell, that is usually not a great sign. I think that's a good risk management technique for events like policy decisions. It doesn't always work though. Sometimes the market can take out the pre-announcement level and then resume the move in the quote-unquote right direction anyway. Much like we saw with the Aussie today, we had that first initial move in the right direction. Then we saw the markets rejecting that, and eventually it moved back in line with the 25 and the terminal rate repricing. it's not always gonna work that way. Normally, when you see that pre-announcement being taken out, that's a big warning sign. There will be times when the markets might be focusing on the wrong thing. When markets might be moving against the trade and taking out that pre-announcement level, and then reverses and push in the right direction anyway. Those occasions takes a little bit more practice and a little bit more conviction to stay in those trades when it changes direction so quickly. I think a trade that comes to mind on the back of this is the one we took with sterling last week when we had that Bank of England a gilt purchase announcement. That was something that you needed to have conviction in the thesis for the trade to hold on to it, because the immediate reaction was let me show you in the smaller time frame here. We had that initial pop to the upside, which was great. This one over here. And then suddenly the market started to reject and reject and reject, and we took out the pre-announcement level fairly quickly. Now, for many traders that traded that to the upside, they got taken out at the below the pre-announcement level, because that's normally a very good spot to use, and normally a very good place to have your stop, to say, okay, if we take out that level, I don't want to be in that trade. At that time, though, personally, I thought that the reaction wasn't the right one because of what I thought the gilt purchases meant for the markets, the reason why it was being done, not being done to stimulate the economy or to necessarily lower long end rates because you are at the lower bound like you normally would with QE. That was really a market dysfunction intervention, a bond market dysfunction intervention move, which gave me conviction to hold on to it, and eventually the trade worked out. But it takes a little bit more practice to know when the markets is taking. I don't want to ever say the markets takes the wrong view, because the market is never wrong. Up or down, the market is always right. It's us that's either right or wrong. So I wouldn't say that the markets got it wrong. I just think the markets focused on the wrong thing at that time. But it takes a lot of practice to be able to hold on to an event or hold on to a trade that pushes against that pre-announcement level, because that's normally a very good barometer to use. So that is something that you can always rely on, I would say, as a good risk management tool. Again, it won't always work, but I think that's better than not having a way to get out of the trade, if that makes sense. That's normally a very good barometer, I think, to use. Now, when it comes to not trading on the initial rate adjustment, the times when I would not get in is if we see rates not putting in a big enough surprise, right? Even if let's say markets was pricing in 45 basis points today, and we got 50. Technically speaking, there is 5 basis points there to play with, which can see upside repricing and can obviously be positive for the Aussie. And I would have expected to see a tiny bit of upside for the Aussie. But for me to get in before I see the statement, it needs to be a really big surprise, a surprise that by doing your preparation beforehand, that you just know, okay, the market is going to be offside if we get that decision. If it's something that's close to consensus or as consensus, I almost always wait for the statement to see what the statement says. If there was a lot of pre-positioning, of course, going into that event, then if the statement comes in exactly as expected and the rate decision is exactly as expected, you can obviously sometimes look to trade that even as a sell the fact reaction. So those are the only times where I would wait, is that if the rate decision doesn't have a big enough surprise. But normally, if you get that really big surprise on the rate side, normally that's enough to get me in immediately. And then I would look and read through the statement to see if there's anything more substantial to take away from it. So I hope that helps with the question there, Yannick. Any others, don't hesitate to let me know.